Hello, I'm Nicholas Hyatt, Investment Manager here at Wealth Club, and today I'm with Joshua Northrup and Shauna Flanagan of Whitman Asset Management to talk about the Whitman AIM Inheritance Tax Portfolio. So, Josh, Sean, could you tell me a little bit about Whitman Asset Management and about your own backgrounds?
Certainly. Well, firstly, thank you very much for having us on the show today. Whitman Asset Management is a small investment business founded in 2018, and we have a specialty in managing money in UK smaller company strategies. We incepted the business with our AIM service, actually, about 5 years ago now, which now has around 60 million of client assets in it. And we've since gone on to launch a smaller companies open-ended fund as well. And we have also got a private client division managing money on behalf of high net worths on a sort of global multi-asset basis. We're a small team, and we've all left bigger places to be part of Whitman. I, prior to helping set up the business, had spent 5 years at Hargreave Hale, which is now part of Canaccord, and we strengthened our team at Whitman by hiring Sean in January, who I will let introduce himself.
Thank you, Josh, and good morning. I've been investing in UK equities for the last 25 years, focusing predominantly on smaller companies, and joined Whitman in January of 23 to help grow both the AIM portfolio service together with our open-ended UK smaller companies fund. Prior to joining Whitman, I was responsible for the AIM portfolio service at Charles Stanley, and over a decade or so grew the assets from 27 million to over 500 million, whilst delivering market-leading returns. Throughout my career, I've helped a number of businesses launch or scale an AIM portfolio service, and for me, the attraction of joining Whitman is the opportunity to do that at a relatively early stage and replicate the success of the past.
So, Sean, the AIM IHT portfolio, how does that actually aim to help investors?
The Whitman AIM portfolio service is designed to mitigate an inheritance tax liability, enabling families to pass on more of their wealth to their loved ones, whilst providing equity-related returns. And this is achieved by investing in a portfolio of qualifying AIM companies, and if held for 2 years and beyond, they're zero-rated assets for inheritance tax purposes. And in order to qualify, there are 2 simple criteria the companies must meet. They must undertake a trading activity and can't be listed on a recognised investment exchange. Importantly, AIM itself is not an RIE, a recognised investment exchange, hence they qualify for business relief. And in terms of the service itself, the real advantage of the service, it's relatively simple, it's relatively quick compared to other means of mitigating inheritance tax, and importantly, the client retains full control over their assets, so they're free to realise them should their financial circumstances change.
And AIM is obviously quite a big market. Outside of IHT qualification, what do you look for in the companies you invest in?
So given the nature of the service, we are trying to adopt quite a conservative approach. We are very much focusing on the larger, more established and profitable businesses. What we're really looking for is proven business models with experienced management teams, ideally businesses that are operating in long-term secular growth markets. And we're looking for high-quality businesses. And by that, what we mean are businesses that currently achieve and are able to achieve going forward, sustain high returns on sales and a high return on the invested capital. Ideally, what we're looking for is businesses that have been through a whole series of recessions and have stood the test of time. And whilst there are a range of companies on AIM in terms of their stage of development, and there are still some relatively early stage loss-making businesses, what is interesting with the portfolio is the size of the companies that we invest in. And if you look at our portfolio today, on average, the companies are capitalised at over £600 million. And again, on average, the companies today are generating north of 35 million pre-tax profits and have been trading for over 50 years.
Are there any companies or sectors that you exclude completely?
Okay, again, given the nature of the service, we are trying to adopt quite a defensive approach. There are some sectors such as biotech, early stage biotech, or perhaps resources, where often they're binary bets. They're not really suitable for this type of service. So anything that's pre-revenue, loss-making, early stage is just simply not suitable, in our opinion, for this type of service. Equally, we are trying to avoid highly cyclical businesses. What we don't want is the cycle to turn and the client to pass away or the estate to be in administration during that period. And again, we're also looking to avoid businesses that are highly indebted. What we don't need is a high level of financial gearing together with what's generally seen as a relatively high level of operational gearing within smaller businesses. ESG is an area of focus for us, and we tend to focus more on the governance of these businesses, and what we do want to ensure is that our interests are aligned.
Could you give me some examples of recent companies that you've added to the portfolio?
Yes, so I want to give two examples, and they're very different businesses in terms of their stage of development. The first is a leader on a regional basis, and that's Youngs. And they're a London-based pub operator, been trading since 1831, so almost a 200-year history. And today, Youngs owns and manages around 200 freehold sites in and around Greater London. And the great thing with Youngs, it's an example of a business that's been through a whole series of recessions and certainly stood the test of time. It's got a fantastic balance sheet. Those freeholds collectively are valued at north of £700 million. And because the estate is so well invested, it achieves industry-leading like-for-like sales. The other example is Neox. Neox is a medical device business, a relatively new business for us. It's only been trading for 25 years. But the interesting thing with Neox, it's a global leader. And here they help diagnose asthma, and they have a certain test, a pheno test, and they've got a 90% share of the market globally for pheno testing. And the pheno test is the test that's recommended by most health bodies globally. And the great thing with this business is that it achieves a very high return in terms of gross margins and in terms of net margins, and it's an asset-light business, so again achieves a very high return on the invested capital.
And Josh, could you give us some examples of any classic Whitman stocks that have been in the portfolio, maybe since inception, but certainly for a long time? Yeah,
absolutely. I'll give two examples. The first is a company called Gamma Communications, which is currently capitalised at about £1 billion. And their core service is providing cloud-based telephone and communication systems to companies, both in the UK and also in certain European nations as well. Remarkably, still over 50% of companies use traditional hardware phone lines, and over time there's a trend to move that all into the cloud. So Gamma are benefiting from that shift, which will take a many number of years, out into the future to happen. The business is very resilient. You don't typically turn off your phone lines, so it has very high recurring revenue. About 90% of the revenues are recurring, and it's got high margins, about 20% EBITDA margins, and it throws off a lot of cash. So it's currently sat with 120 million of net cash on its balance sheet, and that's forecast to rise to 180 million by the end of next year. So that's almost 20% of the market cap in cash. Currently trades on 15 times forward earnings, which is the lowest multiple that it's been on, I think, since it's been on the market. It's experienced a massive derating over the last 2 years, but is fundamentally a very high quality business. Another company is a company called Lok'nStore, which is capitalised about 200 million, and this is the third largest self-storage provider in the UK. They've got about 40 self-storage sites, split broadly sort of 50-50 between owned and managed, and also just managed on behalf of other investors as well. And then the UK self-storage market is, compared to other markets, sort of structurally undersupplied. So for a number of years, there's been very tight pricing and high occupancy across the sort of national estate, which means that it's, that a lot of the providers are increasing the number of sites annually. And Lok'nStore have got a pipeline fully funded for an additional 11 sites, which will increase their trading space by 40%. So, and that's fully funded. It's got a loan to value of about 9% at the moment, which puts it on the sort of lowest geared in the sector. That also trades at a very attractive multiple in our view, sort of 30% discount to its net asset value, which is forecast to grow about 40% over the next 7 years. So we think current valuation of that stock is highly attractive. It's also run by its founder, who owns still 13%, a chap called Andrew Jacobs. So when would you decide that it's time to sell one of those kind of long-term holding stocks? What is it that makes you decide that it's time for something to leave the portfolio? Well, I think firstly we are looking to invest it for the long term, and by steady businesses with proven management teams that have stood the test of time. But of course, things do go wrong and things change. One of the things that we keep a close eye on is leverage. So how much debt on the balance sheet is there? It tends to be over leverage that topples a business when the cycle turns. Yeah. So a management team that are accumulating lots of debt is something we'd be very conscious of, particularly if the underlying business is, not sort of very resilient. I think a change in strategy that wasn't communicated with the market particularly well in advance would be a cause for concern. I think margin erosion is something that we look at. Companies that are getting their margins squeezed, that's often a sign of increased competition in the market, and potentially that business may not have quite the competitive edge that we anticipated. So those are some of the things that we look at. And of course, the other is that maybe just a better company comes along. We run portfolios of 24, 25 stocks, and every now and then something very compelling comes along, and we might replace something just because it's the weakest link.
You sort of alluded to this a bit when you said that your companies you invested in are on very low multiples by recent standards.
Yes.
But it's been a very challenging time for AIM in the last sort of 18 months. How has that affected the portfolio?
There was a small uptick in terms of AIM post-COVID, but from the September 21 high, AIM is now down 45%. That largely reflects the increase in the discount rate. And what we've gone through is 14 consecutive increases in the base rate in the UK. And with an increase in that discount rate, it has unfortunately reduced the future value of those earnings when discounted back to the present value. So it's tended to be the higher growth-orientated stocks that have impacted the most by this. And of course, what the markets felt most uncomfortable with is the uncertainty. Up until recently, we simply didn't know where interest rates were going to go, and therefore we didn't know what discount to apply. It now appears that there is a bit more confidence in terms of where interest rates may well peak.
So in that environment, what do you think the biggest opportunities on AIM are at the moment?
OK, so we see opportunities across the entire market, and that's partly reflected today in terms of the level of M&A. Almost on a weekly basis, we're losing a business, and a high-quality business, on AIM. So the number of companies is shrinking, but the quality of those businesses is also improving. Also, what we are seeing are companies buy back their own stock, and that reflects perhaps the management's view in terms of their valuation, together with the strength of the balance sheet. But it's the high-quality businesses, the growth-oriented businesses, that have been impacted the most by the increase in that discount rate, and that's where we see the greatest opportunities. And for me, it's interesting to look back at previous cycles and what happened both in 2001 and 2008. Right now, we've gone through 2 years of drawdown in terms of smaller companies. Well, both in 2001 and 2008, it was 18 months. And this cycle is certainly coming to the end or towards the end. And it's interesting to look at what happened post the trough, both in 2001 and 2008. And investors enjoyed very strong returns from the lows. And that's the type of return that we should expect going forward.
And how risky is AIM?
AIM has matured significantly over the last 20, 25 years. When I first started, there was a stat, 1 in 4 companies on AIM were profitable at that point in time. Today, that figure is 3 out of every 4 companies. And in terms of the returns that investors should expect going forward, I think it's similar to the 250. However, we are investing in slightly smaller companies, and therefore liquidity does have a bigger impact, both on the way down and again on the way up.
Finally, Josh, if I was going to invest in one AIM IHT service this year, why should it be the Whitman AIM IHT service?
Yeah, so I think we have a very experienced and dedicated team of 3 people working on the service, pretty much exclusively along with the fund. That puts us very well resourced compared to a lot of our peers, and Sean has been doing this for a very long time, and George and I have both been, got well over 10 years each. So I think that's one. I think the other is our size. We've got 60 million in the service at the moment, which puts us at a nice size compared to some of our much larger peers in terms of being able to get in and out of investments. Liquidity can sometimes be challenging, so 60 million gives us a good runway, many numbers of years of growth without starting to come up against those liquidity constraints that one has when they've got perhaps a couple of 100 million under management. And I think the third is really, we all worked at much bigger asset managers before, where perhaps they count their clients in their hundreds or millions or billions. We count our clients, by their names. We know all of our clients. We've spoken to them all. We know them by their names. As a business, we've got 150 million of assets under management. We're small. We're a small team of 7. And we're very focused on this. This is absolutely core to what we do. And I think, we're well aligned to the success of our clients, hopefully, by being sort of, big equity owners in the business and wanting to make a great success of the business by doing well for our clients.
Joshua Northrup, Shauna Flanagan of Whitman Asset Management, thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.